Today, myself and our senior associate, tax and duties lawyer, TomWalrut, joint presenting a webinar on land tax. We're particularly focusing on Queensland, but having a bit of a look at some of those other states. Now, TomWalrut is, as I said, he's a senior associate, been admitted for 10 years last September. Congratulations, Tom.
Thank you. Appreciate it.
He has got 2 young kids that keeps him busy, and he reads them Atoids from time to time to get them to sleep. But I think they've stopped that. I think they prefer the fairy tales now.
The inconsolable crying kind of put an end to that one. Oh, Daddy, I want.
So Tom's dad's a tax lawyer, so perhaps he's just trying to educate those kids with those nice tax stories, when they're quite young. Now, as I said throughout today, please ask your questions in that question and answer panel. And there's a prize for the best question. And today, Tom, we've been getting a lot of feedback and there's been a lot of concern from our client base, where there's been a lot of surprise. Their land tax bills have been going up. They've been, for example, gone to visit someone overseas and, had to stay there to look after some family for a couple of years, and then they get hit with all of these land tax surcharges. There's been changes in the land tax rules in Queensland recently. There's been a lot of publicity all around the country with respect to foreigners and absentees and, the additional land tax that they can pay, and, how to set up your structures correctly to help ensure that you don't get caught in that wicked web. But really, I guess, there's a lot of property investment. People are looking for yield, and a theme of today is, I guess, land tax is something that can really cut into that yield, and there's been a lot of changes in that land tax space. Tom, what are you seeing going on in that area?
So, broadly in terms of land tax, it's been around forever, but there's starting to be there's gradually been a more heavy reliance on land tax going forward. Various reasons. State governments like it a little bit more than things like stamp duty because it doesn't go up and down when the economy goes around. It's also a steady source of income for state governments as well, so they like that. What else? It's a very easy tax to administer if you're a state government, for example, because they've sort of got in Queensland maybe 5 or 6 guys in the land tax team that actually run the assessments, and all it is a print off of every owner as at 30 June, and here's your owner, here's your value, here's your land tax assessment, as opposed to the 50 odd people that they need to have in the duty section.
And there's been a lot of talk too of the economists all think that land tax is probably a more efficient tax than your duties. Where do the states seem to be falling there?
So way back when Ken Henry did his report, he advocated the abolition of stamp duty for a broad-based land tax. Main deal there again was that if everyone's paying land tax at a particular rate, it doesn't matter where you live, whereas things like stamp duty, when you actually acquire a new bit of property, it can prevent you from making the right sort of decisions. For example, if I'm on the south side and I get a job on the north side, do I move house? Well, if there's a $40,000 stamp duty bill in it, probably not. I'm stuck in traffic for the next 5 or 6 years until I decide I get sick of it and want to move. So land tax is seen as a very neutral kind of tax. It doesn't necessarily distort how people make their economic decisions, whereas something like stamp duty, there's a million trips and traps as to how you can structure it properly to achieve certain stamp duty outcomes. So it's seen as a much nicer tax, and the economists like it a lot more. The biggest difficulty, as always, is imposing a tax on the family home and trying to sell that politically. We saw that with Malcolm Turnbull when he was talking about increasing the GST and looking at the tax base. Even in places like South Australia, where they've gone ahead and abolished stamp duty on all commercial stock, politically it was too hard to sell to get across the line with a general broad-based land tax on residential property. So residential property is still subject to stamp duty in South Australia.
Yeah, well, I guess land is a pretty hard one to be able to hide, so it seems like it's a tax that's here to stay. And certainly from Queensland's recent example, seems like one that it seems to be increasing as an overall part of the tax pool rather than decreasing. So it's something everyone really needs to, all landowners really need to turn their mind to.
Yeah, definitely.
Right now, I guess I'm just going to see if I can set up this slide, Tom, for a bit of a comparison of, what those the three main states' land tax is. So I'll just have a crack at doing that.
See if technology wants to work for us. So here we go. So there we go.
Yes.
So look, I think if you have a look there, sort of shows that Queensland, 2 points to bring out of this are that Queensland treats individuals and companies and trusts very, very differently. Queensland has a very, very low threshold for acquiring land in a company or a trust, $250,000 on those numbers, as opposed to if you acquire it in your own individual name. Probably on top of that, if you have a look at the rates there in comparison to Victoria, we're probably a little bit lower than Victoria. Victoria's probably a little bit lower than Queensland. Which is just sort of, what makes up the tax mix. But on the same token, for New South Wales, we're probably in the same sort of realm. So Queensland generally, in terms of land tax, comparatively, is probably about middle of the road. Worst places are South Australia, which I think is currently, where are we, about 3.7% on values over 1.1 million. So,
I saw a newspaper article recently, though, Tom, where the South Australian government was saying, they're reducing that top level one, trying to get some of the, potential land investors away from Queensland and down to South Australia. So it might be a bit of a point of competition between the states.
Definitely. They are, politically, it's starting to get very hard to justify a 3.7% on over $1 million worth of land tax, particularly comparatively when you look at, all the other states in the Commonwealth. So yeah, there's a lot of pressure to push that down. It'd be interesting to see what we get in terms of encouragement to invest in local real estate throughout Australia. Again, South Australia, with the abolition of stamp duty, was trying to play those games, but I'm not sure, or at least anecdotally, I'm not sure it sort of happened as much as they want. But then again, it could just be no one wants to move to South Australia. And being a proud Adelaidean, I'm more than happy to say that. So yeah, look, there's the tables. They're pretty all right, but a couple of things also to note is that there's the administration of the land tax regimes in each of the states vary slightly. So, whilst in New South Wales and Victoria, there are comparative rates. In Queensland, we don't have things like aggregation of common interests owned by companies or related companies. So South Australia is pulling that in. I think Victoria's already got it. New South Wales already has it, where if you've got a number of related companies, their entire land holding together is aggregated to determine the value for assessing land tax. We'll look at that.
In those states, Tom, do they aggregate those with the individual, or just they group the companies together?
I believe it's only grouped companies, but I'd always have to go back and double check. In Queensland, we've got some of the same kind of concepts for, when we've got multiple trusts owning the one bit of land, but the Queensland aggregation arrangements aren't nearly as sophisticated as these other states.
Yeah, which we'll get into soon. But just looking at these kind of figures, I think you're just being aware of them to start off with, for your first port of call for any structuring is, if you can stay under that tax-free threshold, well, you're not paying any tax at all. And, you get over it in Queensland, we're a pretty high rate once you get over, that tax-free threshold, 1% for individuals and 1.7% for companies and trusts over that $350,000 mark. So, that they're really hitting you here, I guess, as soon as your an entity's land holdings, exceed that threshold level.
Yeah, it's one of those seem to be progressive kind of taxation regimes where obviously the more valuable your land is, the more you can afford to pay land tax. That's not always the case, but unfortunately that's what we're stuck with. If you also look down there, the foreign surcharge we'll touch on briefly shortly, but that's also there and to be aware of. And broadly, the foreign surcharge was originally introduced as a nice tax grab, but it was also meant to, how would you put it, dissuade Chinese investors from buying residential property in New South Wales, in and around the CBD. And the idea being that it's already hard enough to buy property in Sydney. Why do we need foreign competition as well? And that has broadly been picked up by every other state around residential property. So we'll deal with that and some of the egregious consequences we've seen in practice coming in a short little while.
And Tom, I guess, so that's where we're at the moment. And Queensland recently just, with respect to these rates, I think we'll get to those soon, they've put those up. But just generally speaking, as far as, any themes that you might be thinking of, where these states are going to as far as land tax and, perhaps when people are planning, their property investments, what they might be wary of moving forward.
So the main kind of things you really want to be aware of when you're planning your land tax are, let's focus on Queensland because that's where we're at. When you're planning your acquisitions and planning your investments, you kind of need to start doing your calculations up front. You also need to make a very upfront decision about your investment vehicle. Things like, if you're your mum and dad investor, do you bother using a company or trust to buy that, your holiday home down on the coast somewhere? Or do you just look at it in your own individual name because you get your land tax? And then there's that trade-off of, well, okay, yes, I can buy it in my individual name. I'm going to get a free kick for land tax. But my asset protection isn't that good, because it's all in my individual name. If I get sued or whatever, creditors start coming, that asset is on the chopping block. So you then need to start looking at, well, how do you do your asset protection, gift and loan backs, mortgages, things like that.
And I guess even when you're planning for your land tax, Tom, you're mentioning that in some states they aggregate, more so than Queensland. And I guess there's always that risk that, rates might go up. They might sharpen those rules up so they've got, more better aggregation rules. So I guess anything we discussed today has got to be really treated with that grain of salt, as in, Treasury can be onto it and, the rules can change tomorrow. So, any kind of structure, you've always got to balance the cost of it up with potential legislative changes, I guess.
And I think it's like you said before, we're not crystal ball gazers. We hear certain things running around, on the grapevine, but you really can't predict what happens in the mind of the cabinet at this point, at any particular point in time. Maybe they see every other state going down aggregation and they decide to do that. I expect it's a matter of time, but it still looks like it's going to be aggregation around companies and maybe not necessarily trust and things like that, at least at this point in time. But as you say, we'll have to wait and see and have to see. And
sometimes it can be very slow moving in Treasury, but maybe, someone in Treasury will be seeing our chat today, Tom, and might hope we don't speed anything up there.
Budget next year, we've got a brand new aggregation arrangement installed into the Land Tax Act. Fabulous.
I'll just pause there before we go on to the Queensland rates. And Bjorn has asked, with trustees, does it make any difference to the thresholds, whether they're a corporate trustee or an individual trustee? And we'll just look at Queensland here.
No, not that I'm aware of.
No. They just look at it on whether it's a trust or whether it's a company. So they don't really distinguish on what that trustee entity is. There is some effects how you set it up in Queensland where the choice of trustee can have an impact. We'll talk about that in one of the strategies soon.
And in any event, when you're doing your registration for land tax, you fill out your Form 1, which is your Land Titles Act transfer, but you need to disclose the trust on what's called your Form 24, which is the second form, which just gets pulled off and gets sent directly to OSR for review. So generally the OSR know if your land is properly owned in a trust or if it's properly owned in a company, individual, not subject to any trust arrangements. That's not to say that people will always fill out the Form 484 the Form 24 correctly. And then it's a fun, how would you put it? Not uphill battle, but a painful battle to get the OSR to recognise that no, this property was owned by a trust. You need to start submitting financial statements since the acquisition of the land that you've lodged with, or that have formed the basis of tax returns and things like that to show that, yes, this is a trust. Yes, it is always accounted as owning this particular property as trust. It's a bit of a nightmare. So you hope that if you're dealing with trust land that you've properly dealt with it on the Form 24, or otherwise just disclosed it on the title up here in Queensland.
Okay, we'll move on and we'll specifically focus on Queensland and the, I guess, thresholds and the rates here.
I think the big thing to note here is if you look at these brand new rates, these are new to this year. Previously, at least for the past 9 years, 2010 to 2019, we've had the same land tax thresholds up here in Queensland. Now, the main reason for that appears to have been that the state government was happy just to allow bracket creep. So, as the values of these properties have slowly increased time on time, they've just said, okay, fine, we'll leave that. We're happy to have people pushed up into the higher brackets, and then they can pay a little bit more land tax, and we'll just let that happen, let that organic process happen. Whereas this financial year, there's that stark increase in land tax thresholds. Particularly, if we look there, we've got a brand new threshold for over 10 million. So we're up 0.5% on what it previously was. And that's both for all of the holders of land there. On top of all of that, companies and trusts, I believe, have gone up about 0.25%. Individuals have seemed to have stayed the same, but for that brand new greater than $10 million threshold, and absentees have gone up 0.5% for the $10 million threshold as well.
And so, especially with your real estate trusts and those kind of ones, it's a huge difference to their land tax bill, those kind of big percentage increases.
Yep, particularly because it's year on year as well. So,
one thing I guess that we see here is you have a look, there's a big discrepancy in Queensland between the tax-free threshold for individuals and the tax-free threshold for companies and trust and absentees. And so you see, that's $600,000, and we're talking unimproved value or site value when we're talking about land tax. We're not talking about the market value. So we're talking about that underlying land value. Get into those valuation questions soon. But I guess from a simple perspective, Tom, when you're looking at an investment, well, you've got your main residence is, your principal residence is no land tax. And then you're talking about investment properties or even non-investment properties, holiday homes or other property holdings that you might have. And so it might be that if you wanted to buy a holiday home, well, you could potentially buy $1.2 million land value between husband and wife, owning it between them and still be under that tax-free threshold. So, that's a fair chunk of land, I guess, for each partner of the relationship to be able to own without paying that land tax. But I guess, as you alluded to before, the downside of that is that it's not great from an asset protection point of view, owning all those properties in your own name, particularly if, you're the kind of person who can afford to buy those kind of properties outright and have that holiday home, you're probably in the firing line for getting sued. So if you are doing that, perhaps, one strategy might be putting those asset protection measures in place to purchase the property. That's, setting up a trust to be the secured lender to buy that property, or, those gift and loan back kind of strategies over there. But, I don't think it should be ruled out, especially, for those holiday homes and those kind of places. I don't think it should necessarily be ruled out having a look at buying some properties in those individual names if you can manage that asset protection risk, because you look at these rates below and it's a big savings from an individual perspective than from a company or trust. Because look at this, the once it reaches $350,000, it's 1.7%, sorry, is what the land tax rate on those unimproved values, of that entity are. And, that doesn't kick in until, it's 1% for individuals when they're over that $600,000 mark. So, there's significantly higher rates when you're looking at investing through trusts, companies, or, if you move overseas.
Yeah. I think that probably gets us into some of the next discussions of, well, if you're going to start investing in some land, or you've got the 2 points, outset, thinking about at the start, what am I going to buy, or how am I going to buy this particular bit of land, as opposed to if you're already in a particular structure, well, what do you do? So again, it's one of those things where I think we're seeing this in the entirety of tax advice and the entirety of legal and the accounting world, that people are now starting to realize, well, we need to sit back and have a chat. What is the purpose of the investment? What are we going to do with it? What structure suits your own purposes, as opposed to a one size fits all, which might have been appropriate a while ago. So things like, if you're going to be buying a block of land as a development site, well, do you turn your mind to a company? Do you have, at least in Queensland, do you have multiple companies to get multiple access to the tax-free thresholds? Now that needs to be balanced on any sort of anti-avoidance type argument. So there needs to be good reasons why you're buying it in multiple companies. But there is something to turn your mind to. Also, same sort of thing, would you use multiple trusts? If you use multiple trusts, the asset protection arguments or the estate planning arguments start to get a bit better. Because if you're buying a big block of dirt worth 1 point something million, up to about 1.3, 1.4 million, you can have multiple trusts, up to 4 trusts owning that particular property. It could be one for you, one for the wife, one for the 2 kids. And we're starting to see those trusts with capital to move forward. So that makes sense from an asset protection and estate planning perspective to do that. Yes, you get a free kick on the land tax, but it's all explainable and you're doing it all for a reason. So, you say gold standard, sort it all out, do it properly from the start, or alternatively you can use multiple companies, things like that.
I guess just looking at those figures there, Tom, is, like you were saying, as in from an individual's perspective, having husband and wife buy the property as tenants in common between themselves, well, that's $1.2 million between the two of them they can have before they're entering into, they're past that tax-free threshold. For your trusts and your companies or your absentees, well, they can have up to 4 people on there. So what's that, 350, that's $1.4 million between those trusts. There's a few tricks with how you've got to set it up, though, in order to satisfy these rules. And what it was is back in 2010, they changed the Land Tax Act in Queensland. And, we thought that it was going to be the end of being able to use, a client might have 100 trusts owning, different properties around the place. And, each property might be owned by 4 trusts. Certainly we had some clients, they weren't owning each property in 4 trusts, but they'd own each separate property in a different trust. And they, come 2010, they had the same trustee, though, for all of those trusts. So, each property would have the trustee being trustee for that special trust. And it makes a lot of sense from an asset protection point of view. So if one property owner gets sued, the most they can lose is that specific property, not all of, their property holdings all throughout Queensland or the country. Now, in those 2010 changes, is they said, well, if there's a trust and it's got the same trustee and ostensibly the same beneficiaries, then they're going to group them as if they were the one trust. And so then, we delve down into the details of it and who's a beneficiary of that trust. It depends who's been distributed to. But the easiest way, to kind of fix that problem, and makes a lot of sense from an asset protection point of view too, was changing the trustee of those trusts so that each separate trust had a separate corporate trustee. That way, those 2010 changes will, each trust got its own $350,000 tax-free threshold. So we were very, very busy in June 2010, running around doing all of that and getting the consent of the mortgagees, to comply with those changes. And you can imagine, it's not that hard that could be changed again. So, any of these kind of discussions, you've got to have a look at, is it worthwhile doing? Does it pay off pretty quickly? And is there, a reasonable explanation for doing it rather than just the tax savings? And, you're having a look, well, you've got your ASIC fees for each company, you've got your setup for each company. So you've got to, always do a bit of a map and see what exactly is it going to cost you setup wise and down the track. But what about that situation where, let's say, there might be a property that's owned via one trust?
Yeah.
And here's Tom's version. And, what's Homer's predicament here, Tom?
So the big problem we've got here is that, Homer's bought the property 10 years ago. When he bought it, the unimproved value was 3/5 of nothing. So, his land tax was bugger all. He didn't care, well and truly under the $350,000 threshold that we've had for 10 years. But slowly, it's creeped up and up and up. Now we've got a site value of $1 million. And Homer's getting some particularly heavy land tax assessments each year. Luckily enough, in Queensland, what you can do is we've got a duty exemption, or technical duty exemption, for clonings of trusts. So we can take the Homer trust and we can split that up into 3 separate trusts, up to 4 for land tax purposes, without actually incurring any stamp duty. So what that means is we can take a very heavily taxed piece of land here in the Homer trust, split it over 3 trusts, not pay stamp duty, and have access to the tax-free threshold of $330 each, and then that brings the land tax assessments down to 0 as well. Can you just double click? There's some photos of Bart and Homer on these trusses. There we go. So yeah, here we've got Homer going to Homer and his 2 kids, Bart and Lisa. Again, explainable from an asset protection, explainable from an estate planning type arrangement. The downside, unfortunately for this, is you have some capital gains tax consequences when you transfer the asset out to 3 new trusts. The trust cloning exemptions that haven't been around for about 5-6 years now. So you've got to look at other ways to manage that. But you also look at what the value of the land tax is, what the value of the land tax is and the stamp duty saving compared to what you're paying in, or what you might pay in capital gains tax, plus an uplift in the cost base for capital gains tax purposes.
And what I've seen with some clients there, Tom, is that some clients, for example, there might be some properties that have gone down in value where, it also triggers a capital loss, or they've sold a property for a capital loss. And so, if they do some smart management like that, they might be able to manage moving forward some of those capital gain issues. Sometimes people just weren't structured correctly to start off with, and there hasn't been a lot of improvement in that property market. But, if there's going to be a whopping big capital gains tax bill that you got to pay now when no one's actually paying you any purchase proceeds for the property, you might be thinking twice just to do this, just to get the land tax savings. Not that you'd be doing it just to get the land tax savings, of course.
Definitely.
Which is a good point, I guess, to just have another discussion of those anti-avoidance provisions, which, peppers all through the Land Tax Act in Queensland. There's some anti-avoidance provisions. Tom, what do you think of those, and how do they compare to the Commonwealth tax?
So the state taxes anti-avoidance provisions are, you'd call them less sophisticated than the federal income tax avoidance rules. They're a lot more outdated, but mainly because they just haven't been tested. You know, federal income tax, anti-avoidance rules, there's so many more people doing so many more things from an income tax perspective that inevitably they're going to get tested. They run up to the High Court. We had the more recent changes when the Gillard government was still in, and all the separate approaches. You know, the state taxes anti-avoidance rules have sort of languished behind that, not being as sophisticated, and not, you know, you got to turn your mind to them, definitely, and you've always got to have a reason for what you're doing. You can't be solely motivated by tax. There has to be other aspects of it, but they're not as catch-all as the federal income tax stuff.
So in short, please do not email your advisors or your lawyers that you want to implement any strategy and say, hey, Tom, I want to save land tax. Can you do this strategy for me? Yeah, definitely. Okay, another big one, I guess, is the principal place of residence exemption for land tax. And all the states have that principal place of residence exemption because, well, they do. It's politically pretty unpalatable to attack the family home. But some of those arguments where they're talking about, abolishing stamp duty and raising that broad-based tax. Certainly the Henry Review was considering that the family home would be part of that land tax mix. But presently we've got the situation where if the property is owned as your principal place of residence, they call it in the state legislation, then you're exempt from land tax. So that doesn't contribute to your $600,000 tax-free threshold for your property holdings. Naturally, husband and wife who are together can only have one principal place of residence. Perhaps when they separate before they divorce, that might turn into two. The relevant time for, when is a place your principal place of residence, all of this land tax stuff is assessed as at midnight, 30 June. So what your land holdings are then. And interestingly, also, it's when you're in possession of that land under, the contract document, not necessarily when settlement happens, which is a relevant testing time for that land tax. But we see, and we don't see a lot of this, but we do see it sometimes. Sometimes we see historically a house has been bought in a trust, and the trust is the owner of the land, which is used by one of the beneficiaries' principal place of residence. And we see this with testamentary trusts quite a bit. But we do from time to time, not a lot, but we do from time to time see this in discretionary trusts too. And just because it's owned by a trust doesn't automatically exclude eligibility for this main residence exemption. What it means is the trust is going to be assessed as a trust unless you can provide the evidence and the paperwork that you're entitled to the main residence exemption. And what's the reason for entitlement is, well, the beneficiaries live in the home. What's a beneficiary of one of these trusts? I'm talking Queensland, a discretionary trust. It's who's been applied, appointed income or capital in the preceding year. If no one has been appointed that income or capital, generally it's the appointor of that trust or those default beneficiaries. Now, sometimes we're left with a situation where it might be that there's a testamentary trust or there's a discretionary trust that owns the home, but also might have other investments and conduct other items. And they might be distributing to outside of, it's got to be each beneficiary of that trust has got to be living in there as their main residence. If it's distributing to cousins and companies and different entities, well, that eligibility for that main residence exemption, just on the face of it, isn't there. Where these trusts have been able to still be eligible for the main residence exemption is where the trust grants a right of occupancy to those people who are living in the house, and in those circumstances where they're a beneficiary of the trust, they're still getting entitlement to that main residence exemption. So from time to time we get, usually it's when the land tax rates have gone up and someone's been a bit peeved and show their accountant, and the accountant gives us a call, and we see, okay, well, we ask a few questions. We look at those financial statements. Oh, there's been no distributions from the trust. Great. Or, you've been living there and there was a right of residence that's been granted. And we can actually apply back, and we've been successful in obtaining retrospective reimbursements, so reassessments of that land tax liability. And how far can we go back, Tom?
5 years.
Yeah, so, we're obviously looking at, what it was each 30 June for those 5 years. But if there is a situation like that, your client is going to be pretty happy with you if you're the one who spotted this ability and you manage to get them, 5 years of land tax paid back. Maybe they'll invite you on their holiday, or that they're going to do the spend with the savings, or at least
justify your bill for the year.
Beg your pardon?
Justify your bill for the year.
Exactly. And tell all of their friends about how good an advisor you are. Now, I'll just share the screen again, and I'll give an example of a case that you're involved in. Well, we were involved in recently, Tom.
Yeah, definitely. So, much like Kieran was saying, when you're able to get a good result for a client, it's always good, and when you're able to get them a reasonable refund, it's even better. So, Kieran, can you click the button again on that? There we go, and one more time. There we go. So this was one of those fun ones where you get pulled in to do an advice on something completely different to land tax.
One minute. I think we've got some difficulties here, Tom.
Years.
I'm not sure if everyone else had that problem, but I just lost your audio for a minute there. So if you please...
I'll go back. No worries. Okay. So, are we good? You hear?
I hear fine now. Perfect.
So, as Kieran was saying just before, this is one of those ones where, if you spot something, you ask, oh, why is that going on? You can potentially get a refund. I think in this case we got about $30,000 back in refunds for the past 5 years for this lady. But it all came about because someone came to us and said, hey, can you give us advice on an unrelated topic? And we pulled everything in. We got the financials for the arrangements. And for some reason in the previous years, we saw there was land tax on this property. Why are you paying land tax? Isn't this your home, or isn't this primary production? So the scenario was we had a lady who owned a bit of property. If you look there, there's her main residence on the bottom left-hand corner. There were two ponds on the property. It was a nice big property. I think it was about 6 or 8 hectares. Nice bit of property. All on the one title as well, which is even better. And on top of that, they ran a hydroponics setup, which I am informed and verily believe was legitimately for growing mung beans and bean sprouts. Nothing sketchy going on here, at least as far as I'm aware. So they had, luckily enough, the growing of these types of vegetables was covered by the primary production exemption. But surprisingly enough, only took up about 2% of the land overall. The balance was just a house and trees associated with the house, gardens with the house, and the ponds. And so, like you did, once we asked, hey, why have you been paying land tax? It's your main residence, and to the extent it's not your main residence, it's your primary production land. She said, I don't know, I've been paying land tax, I just always have. So we ended up dropping in an application combined with the past 5 years worth of financial documents for Farming Co there, effectively saying, hey, this is principal place of residence, to the extent it's not principal places of residence, it's been farming property, give me back my land tax. And luckily enough, at least in Queensland, to get the primary production exemption, you don't actually have to, the entity carrying on the farming business doesn't actually have to own the land. It can be using the land. It is land used for primary production. So we were successful getting 5 years worth of land tax back for this lady. And you know, when you give a bill for X thousands of dollars and you can say, well, I got you back $30,000 in land tax, kind of makes your, justifies your existence, which is always very, very nice.
And I know Steve and I think you, Tom, were involved in one where one of those sporting clubs, you know, had been getting a whopping big land tax bill for all of the land that was held through them. And what happened there? Do you remember?
Recollection, that was a charitable exemption, wasn't it?
Yeah, and so then again, 5 years back. So they were very, very happy.
Yeah, it seems to be that it's not uncommon for people to misclassify what they're doing with the land or what they've been registered with the OSR as doing with the land. You know, it might be that's the advent of the $400 conveyance. You can't turn your mind to all of these things, and you know you can't turn your mind to where we got, you know, what this asset is going to be used for, which is where us as advisors can start to add quite a lot of value going forward to make sure that we're not.
Well, someone was telling me a story just recently, Tom, where in one of these very inner suburban inner reaches of Brisbane, where there's lots of apartments and developments, they were actually running a nursery on a prime piece of land. And nurseries, I believe, you know, if depending on what their activities are, meet that definition of primary production. So it was good use of that inner city land, I think.
Yeah, I'm surprised how many developers are branching out into the nursery business. It's always very good. The other fun one that we seem to see a lot of are chicken farms. Not only just because you get the primary production aspect, but if you're a developer, there's some rules about, I think you're not allowed to build residential premises within a couple of 100 meters of an ongoing chicken farm. So you can buy the land that the chicken farm is on, you can continue to use it for primary production and get out of your land tax, as you rightly should. But on top of that, you're preserving all of the land around your the chicken farm you've just acquired to prevent any other developers getting in there and starting to snap up your property. So lots of fun strategies and lots of fun arrangements that you can implement going forward, particularly in terms of this stuff.
So brings us on to the next topic, Tom, of valuations. And there's an interesting one that, interesting exemption we'll talk about soon with the valuations we turned our mind to. But I guess this is an area where a lot of people might kind of gloss by when, you know, they get the notices in the mail, you know, with all the other junk and the other mail they receive. And of, you know, the what it is, the Auditor General's valuation of your property.
General, yeah.
And you think it's a good thing. Oh, look how much I'm worth today. My land value is worth more. But then a few months later, it might not be as pleasant as experience.
You're spot on. It's sort of, you get your land valuation, you go, fantastic. Look at the little nest egg that I'm sitting on. My site value's gone up. My other values have gone up. Fantastic. And they usually come out, usually March. Then you've got 60 days to get your objections in. And the reason why it's important to get your objections in is that those valuations are the basis of all of your land tax assessments. And with land tax being assessed on 30 June, by the time if you're unhappy with your land tax assessment, and unless you're in an exemption, the main reason that you're going to be unhappy with your land tax assessment is because it's going to be too high, and it's too high because the value is too high. You're now out of time to object to your your land valuation, which came back all the way back in March. You know, there's technically you can get up to a year to object, but if you're outside of the 60 days, you've got to have a really, really good excuse. Like, I was in a coma, my leg had just been amputated, so I wasn't really around to turn my mind to my land tax valuation, sort of thing. And sort of on top of that, you know, as soon as you've missed that, it's kind of all down a hill from there. And on top of that, particularly in Queensland, land tax values the values for land tax are based on a 3-year aggregation. So it's the values over the 3 years that are added together, divided by 3. And that spits out your valuation for land tax. So 1 year can screw you up for 3 years. don't get it done.
And Tom, so you're saying it's pretty efficient, you know, that the land tax team in the Office of State Revenue isn't as large as, say, the duties team or the payroll tax team. But how's that the case? Like, you know, did they send a valuer out to each property and value each property each year before 30 June? That must keep them busy if they do that.
That's the other thing with land valuations. It's a mass decision-making process. So the Valuer General is not going out to each particular property and saying, oh, that's worth this much, that's worth this much, that's worth this much. What they do, and quite rightly so, they need to find some way of valuing the millions of properties in Queensland, is they pick certain sales, or they pick certain properties that they, through various means, identify as being the most valuable bit in that particular part of Queensland, and then they'll almost assign values to each bit of property in a ever-increasing concentric circles from that point, based on that generally higher value. So, for example, at the end of each, when all your land valuations come out, I think they still do it. They did when I was looking around. They actually put online all of the surrounding land valuation values, so you can check your property against your neighbours and your other surrounding properties for free. And you can see, well, my property has gone up, their property is slightly bigger than mine, so it's worth more, and all those sorts of things. But also triggers you, because if you know where the more recent sales are, you can say, well, I know that property sold, and I see the value has gone up significantly after the sale. So you can start to identify which of the valuable properties and why your property might have gone up in value. And I suppose the reason why that's important is if you're going to object, you need to go and give a reasonable amount of information and some reasonable arguments as to why the Valuer General's got it wrong. As we said, it's a mass decision-making process. Mistakes happen. He's not looking at everyone's property. So
it's not going to cut it if you just say it's unfair, I don't like it. You need to be pretty detailed with the information that you're providing them. For example, it doesn't reflect the physical characteristics of the land or the constraints of use of the land. And, that's quite a detailed submission there. Even talking about site value, Tom, like, I guess, most of the valuers out there, we're all familiar with the concept of valuing a house. But valuing this site value, what does that mean? And, what do the valuers look for?
When we're talking site value, we're talking just the land and minor improvements to the physical structure of the land. We're not talking the multi-million-dollar mansion on it. We're just looking at a block of dirt plus, drainage works, some improvements to land, those sorts of.
There might be some fill that's added to it, and might be some retaining that's added to it, and so it might be improved in some manners.
And it's always struck me as a disingenuous way to try to value land, because as far as I'm aware, I don't know that there's any undeveloped property or land left in the CBD in Queensland, or even in Morningside, out where I live. So how you actually go about determining what the unimproved value of land is can be open for interpretation and can be subject to reasonable arguments, because that whole concept of comparable sales, which you might employ for residential sales or valuing a property for sale, just is not quite there.
So it's not just a concept of valuing the market value of the property and then having an estimate of what the improvements are worth and deducting one from the other?
Not quite. There's lots of things that go into it, but there's a bit more science to it. So you can't just say, well, I've got a property, I bought the land for $1 million, I knocked the house off it, and spent another $1 million putting a new house on it, sort of thing. There must be the value. It is part. It's a annoyingly complicated process, and I'll try not to bore everyone.
So I guess the theme with it is don't just go and choose, your regular local valuer for residential properties, make sure you've got a valuer that's experienced in these kind of land value disputes. And some of them are even, at least in their firm, having someone who can give that court evidence and that kind of thing too, because then you've got your options left open if you do want to actually go through the objection process and appeal it, which, you know, for some of your more significant land holdings, you know, several clients of ours have done that. It pays to get that valuation right in the first instance, because you can't go and introduce new evidence further down the track. You know, you got one bite at that cherry, so to speak.
Yeah.
One other interesting, I guess, concept with respect to these land valuations was that an owner of the land who makes improvements to that land, example being putting that fill in there, putting that drainage in there, you know, filling in that pretty unusable swampland or floodplain land. And you can see, you know, a lot of developers doing that and, you know, really spending a lot of money on that land holding to put land that, you know, wasn't worth much. And now the actual land value's gone right up, but they've spent a bunch of money on it. There's, you can actually claim the owner can claim a deduction for the cost of those improvements to the land. And so that's reduced from that value of the land. So it reduces that down.
Yeah.
Yeah.
Very, very good for developers, so long as they've got all the appropriate evidence to throw as to what they've spent on it and what they've spent in site improvements to get those thresholds down. It's really, really good.
So, you know, if you've got developer clients who don't know about that and, you know, there's a 30 June approaching, you know, they should, you know, perhaps have a look if they're entitled to that deduction. And Tom, do you think, again, is this one of those situations where, you know, 3 years ago they held a bunch of land that they'd spent a bunch of money on and got a big land tax assessment when they're, you know, through the hadn't finalised the subdivision process? Is that something that they could possibly get a retrospective refund on?
Generally, you're only limited to a year because you've got to object the valuation to use these deductions, and your rights to object to the valuation are completely extinct after a year, sort of thing. So you need to do it within those 60 days. But, you know, try it on.
Now, with that deduction, though, where it doesn't apply, it applies for the person or the entity that actually spent the money on those improvements. You don't inherit that when you ultimately buy the property. So, you know, you're stuck with the land value then. So it's just, you know, I think it's specifically been put in there for those developers who, you know, it's a bit unfair that, you know, they bought land worth, you know, $3 million and they spend $2 million on it, and now the land's worth $10 million. It's a bit fair that, you know, due to their own work they did with it, they're copying such a much bigger bill. So at least they're getting a bit of deduction for what they've spent on that.
Yeah.
Now, the big one, we don't have a slide on this, but this has got lots of media attention lately. And, you know, I think most of the states have now got a separate taxing regime and rates for foreigners and absentees and potentially, you know, trusts or companies that are deemed to be foreigners or absentees. Tom?
Yep. Again, I think we touched on this a little bit earlier. The idea was to stop Chinese investment in CBD in Sydney, and that has now broadened itself out into effectively residential land throughout Australia. You're getting a surcharge of 2%. The idea being that it's very, very easy to tax foreigners. It's much more difficult to tax your constituents. So we've seen some particularly egregious examples. Queensland, when they initially introduced it, it was on the basis of where you were a resident. So we've had two quite horrible situations. One, we acted for a lady who was still an Australian citizen, had moved to PNG to operate a business, and, you know, a holiday motel kind of thing up there. And she had 3 properties. One that she was going to retire in. It was a nice bit of farming land. Sorry, not farming land, but vacant land. And 2 apartments for the 2 kids. Because because the Land Tax Act was drafted quite poorly in Queensland, she was caught out and she had a $30,000 land tax bill between these two properties when really she shouldn't have had it at all. The other one, if she was, it should have been about three or four grand because just the surcharge was so much on it. The other situation where we saw people get caught out was we had a bloke who had to go, he had to leave Australia to go care for a sick relative overseas. So, being the good family member, he picked up, he went overseas, he was there for 2 years, and because he was no longer resident in Australia, he also got back, I think this time with an 18,000, so 2 years worth of land tax. So I think it was 2 years worth of $15,000, absentee plus surcharge. And when you're getting those sorts of land tax assessments, when you just when you've done the right thing to go out and help family, it really is a kick in the guts. Luckily enough, they changed that at the start of this year to exclude from the foreign surcharge permanent residents and citizens, but we've still got a number of people with some horrible land tax assessments, and there's just nothing that they can do about it because the arrangement or the legislation wasn't drafted particularly well.
Well, I guess it was pretty cut and dry, that legislation, and then it's not hard to really gather the evidence that you weren't in the country. One from whether you do your tax return, or two, your departures and entry information. It's something that's pretty hard to have a factual dispute on. If depending on how it was drafted.
In a lot of these situations, people are just getting an anonymous call from the OSR saying, "Hey, are you living in this property?" "No, I'm overseas doing this." "Oh, okay, thanks." Hang up.
And by then, I guess they've already kind of busted you. They already know that you're not living there, and if you tell them porkies, you're probably liable to get stung with higher penalties and that kind of thing too.
Definitely. So. Glad it's not going to be too much of an issue going forward, but it's still.
And I know there was that big, especially in New South Wales, there was a lot of focus on provisions you might have in your trust deeds, which include foreigners. And
that was just a particular problem because they don't have in Queensland for trusts. We've still got concepts of trust interests, and that just looks if you're a default beneficiary for a discretionary trust, and that's who your trust interest is, or who controls the trustee. That's how they assess it up here in Queensland. Whereas in New South Wales, they don't have those concepts. So what they did was they used the control or beneficiary concepts out of the Foreign Acquisition Takeovers Act, so the FIRB kind of tests. And what that ultimately meant was that anyone with a potential interest in a trust, so if you've got a nice broad objects clause in your discretionary trust, which every discretionary trust in Australia has, you're effectively a foreign trust. So everyone's been running around in New South Wales changing their trust deed to exclude from the beneficiary clauses once and for all any foreign resident, and those changes need to be irrevocable and forevermore, which is, again, it just shows you how quickly and how not as well thought out these changes have been.
Making such a change to a trust deed could have unforeseen consequences, i.e., one of your children might not be a resident for a period of time, and are they permanently excluded from the trust because they were a foreign resident for a period of time?
Well, if my son decides 15, 20 years time, moves to Japan, finds a nice Japanese girl and marries her, needs to give up his Australian citizenship to take that Japanese citizenship. He's out of the trust, no access, and a lot of families, most of the wealth is tied up in the trust, and you then have your estate planning considerations which go along with that. And, well, how do we deal with that going forward? And horrible stuff.
So look, that kind of deals with our our strategies and our exemption side of things. But one item we'd still like to talk about is, how you might draft for potential land tax liability. And, I'm particularly thinking here of your, contracts to sell and buy land, and of course your leases for land. with respect to your contracts for buying land in Queensland now, it used to be that we had a land tax adjustment standardly in the REIQ House and Land package. Now there's no land tax adjustment in that contract. So that same contract is sometimes used for some pretty big vacant land and some pretty big properties. And so I guess turning your mind, if the vendor's incurring a lot of land tax, you might want the buyer to be contributing to some of that land tax liability, because it's what those holdings were on 30 June. So might want those special conditions there. In the commercial contracts, typically the clause in Queensland is that the land is assessed as if it was the only land owned by the seller, and as if the seller was an individual, regardless of whether the seller was a company or trust, regardless of how much land the seller owned. So, from a seller's perspective, you always want to be changing that. So it's on the actual land tax paid, or at least on the basis it's assessed on, the company or trust rates. From a buyer's perspective, you're pretty happy to keep in there, that it's on that natural person arrangement. But, every kind of contract at that front end, before you're committed, we can be talking, tens of thousands of dollars, or, in your normal kind of contracts, thousands of dollars. So, getting these things right is very important to our clients.
I think on the same token, things like commercial leases, when you're dealing with a bigger end of town and the bigger rental amounts, under the Retail Shop Leases Act, you're generally prevented from passing on land tax. But you can move in and out of that particular piece of legislation. So if you're doing a big commercial lease, you need to also turn your mind to whether or not you can pass on this land tax, particularly if you're a landowner, to the tenants, which is always particularly important, and also goes down to your particular drafting of your commercial lease. So again, turn your mind to it just like you would in the sale contract.
And in kind of summary there, I guess, is even, I guess, from your retail shop perspective is, as you're saying, was your the tenant isn't allowed to pay the land tax. That's presently the retail shop leases legislation. But ultimately that's reflected in the landlord still wants a certain return. And so that's reflected in a higher rent for those retail shops because the landlord's factoring that in. One way landlords might still be able to get higher returns is, doing some careful structuring and reducing their own land tax bill. So, they're getting that higher yield from it. And sometimes there's some, there's clauses under the leases where, any future taxes are incorporated and, the lessee has to pay them. From that tenant's perspective, again, it's all about that yield. And, if as a landlord for a commercial lease where the tenant is paying that land tax, well, I think, properly informed tenant and properly informed landlord, it should ultimately be about, well, what does it cost me? And if the landlord's paying less land tax, well, hopefully that should mean that the landlord can, charge more rent, when you're looking at it on that kind of gross perspective.
Definitely.
Which kind of segues into, our kind of summary for, our takeaway for today. We're not going to repeat all those tips that we told you, but I guess, turning your mind to land tax. Property investment is all about the yield, about the cost, and land tax is a relevant factor there. If you can do it before you buy the property and you consider, the land tax and asset protection and income tax and capital gains tax implications, it can be considerable savings over the lifetime of that investment. And, ultimately that's, more wealth that's been accumulated from making those right decisions at that front end and those right decisions on the way through.
Definitely. Lovely.
So I've got one question. We'll go to questions now, and keep them coming for for the competition for this bottle of wine. So far, Michael is the winner of that one. But let me have a look of what other questions we've been asked. We've got Scott here. He's asking how to correctly apply the main residence exemption for elderly people left home to live with his or her children due to illness, not capable to live independently. Just trying to work that. It's hard to tell. We can't really answer that one. I'm sorry, Scott, unless we know who's the owner of the property we're talking about. If you can reply to us with that, or we might be able to give some further input into it. Otherwise, it shouldn't really, it shouldn't be a drama from a main residence exemption in your normal cases.
And there are also specific provisions within the Land Tax Act which covers things like multiple residences having to leave the residence for care and things like that. What happens if you've got a residence, or you buy a new residence, you're just trying to build it, whether or not you get the main residence exemption on that, all those sorts of things. So you really, almost on a case-by-case basis, you need to step through each provision. You need to step through the Land Tax Act to see what exemptions are applicable and if they do apply to your particular fact pattern.
And what else do we have here? I think we've failed today is one of the feedbacks from one of our participants, Tom. Monica has said that despite the title of Stop Whinging and Start Planning, that she is still going to whinge about land tax after today. Maybe she's even going to whinge some more. But if we can make you whinge less, we've done our job well.
Definitely. It's the aim of the game.
Yeah, the land tax exemption. So Dick has said that the land tax exemption on residential is only applied when all beneficiaries live at the residence. And yeah, that's going into when it's owned by a trust. And so having a look at what that definition of a beneficiary is under the Land Tax Act, getting that right. And it's also, then if we haven't satisfied that, trying to get that right of residence. For your main residence for your home, if you're leasing out part of that home, personally, you've got that income producing component to it, then you might not be entitled to a full main residence exemption then. And they do send you those questionnaires almost every year, is this still your main residence? And so you've got to work through those questions and be careful of the people who are using Airbnb and, those kind of things have to take care that it might mean that they're not eligible for that main residence, that principal place of residence exemption if they have had that income producing purpose, or, it's not being lived in as the principal place of residence.
Definitely.
So Dick again says his next door neighbour is One Steel. So Dick, where do you live? On an industrial estate, mate? Your insurers increased your rate on ISR due to One Steel being a metal recycler. I won't give your address out to everyone there. So Dick, I'm not sure how I can help you with your insurance rates. Maybe it's time to move your main residence to the beach or somewhere a bit more friendly than living next to One Steel, hey? But I guess Tom, on that grounds, Dick, you might have, if you weren't living there and you weren't getting the main residence exemption there, the principal place of residence exemption, the use of your property is for the purpose of One Steel's use of the property. So that might be a valid ground to object upon the valuation that gets issued each year. So there could be possible grounds there. But we're sorry.
Things like noise and things like that. Can be used as a grounds for reducing that the value of general's valuation.
But everyone's a case-by-case basis, so it'll be one of those situations where you'd put your best case together, see all the things that might impact on that value of the land, and see if it's worthwhile making an objection to that valuation. You got to have a look at what that land tax bill is and what the likely cost of getting the valuer and getting that evidence together. Is it worthwhile going through that process with the hope that it won't be just that year that you're saving land tax in, that should be reducing, that assessment for many years moving forward. Just going to have a look here. Any more questions? For Airbnb, is there a pro rata home exemption or would you lose it completely? I've got to look up the Land Tax Act. I'm sorry for that one. Bjorn or Tom, do you know off the top of your head?
I have to go back and look at the definition of non-exempt purpose. But if you're using property for multiple purposes, then there is a set off. But like everything, you know, what's the value of that versus this? What part of the land are they using for the particular purpose? And again, one of those things you sort of step through.
So it'd be, I imagine, without having a look at the details, Bjorn, it'd be a bit like your main residence exemption for CGT, as in if you've got a, if you know that there's some other use there, it gets apportioned. But can come back to you on that one properly when we have a look, Bjorn. And any more questions, anyone? Anyone else in the panel for this one? I'll look at the Q&A. Yeah, sorry, Dick, it was, you don't live there. It's your workplace. I misinterpreted that one. I'm sorry.
Put a nursery on it? No.
So, you know, we can certainly talk offline, Dick, and see if there's a good case for reducing that land tax bill. David, my client owns 2 properties in a discretionary trust and is assessed on the combined value. For succession purposes, he'd like to split the trust so he can leave one trust to each of his children. Would such an arrangement be structured to avoid stamp duty? Well, I guess you can split that property into 2 trusts, like we said before, without stamp duty. So there's an exemption for that. So, you know, there's no anti-avoidance in doing that side of it. And, you know, this is for asset protection, for succession purposes, you know, so which makes a lot of sense. So, you know, your children, you know, each have a discrete interest, not having to share a trust between them. So that all makes sense. And, you know, there might be some capital gains tax though on, you know, creating a trust over half of that land. And, you know, so just got to weigh that up. But in that case, you know, there could be some, you know, significant ongoing land tax savings, as in, you know, the land tax bill could be reduced right down. The other thing to watch out for, I guess, from succession purposes is, you know, if you've got one property earmarked for one kid and another property earmarked for another kid, both properties have got different cost bases and different capital gains tax treatments. And then, you know, the nature of the property market, one might go up a heap and the other might not shoot the lights out as much. So, you know, sometimes children can be a bit bitter and twisted as if the estate plan was on that property basis and one property shut the lights out and the other didn't. So just a bit of care of, you know, how that's managed with the relationship with the children, I guess, too.
It reminds me of a matter we were dealing with a number of years ago where there were 2 brothers. One owned the property that was centrally located and was getting about 100 grand a year of rent, 150 grand a year of rent, but the property was only worth about $2 million. The other property left to the other brother had just been rezoned, so it had gone from $2 million to $19 million. But the brother with the rent-derived property had never given any cash to the brother with the very valuable $19 million property. So when this brother said to this brother, hey, you're going to give me half of that, right, aren't you? He said, no, I'm not, because you've never given me any cash out of your property, so go and get stuffed. And then that was a big Barney. So yeah, turn your mind to the nature of your investments as much as you possibly can when you're doing these sorts of asset protection or succession planning processes.
And Scott has just, you'll remember, was about the elderly parent, and I'm understanding the situation there now. The elderly parent owned her own home and she had to move out of her home to live with the kids because she was quite sick and ill, and now she's got a whopping big land tax bill that, you know, everyone's whinging about, and because she got assessed for it no longer being her principal place of residence. And it is a sad story. You know, she can't help getting sick and, you know, is hoping to get better and move back into it. But sadly, they look at what the situation was on the particular 30 June. And, you know, if she wasn't living it in there as her principal place of residence at that point, yeah, you know, it's pretty hard to get out of that bill. You got any tips, Tom, of what might still make you that principal place of residence side still be able to meet that criteria?
There's a specific exemption within the Land Tax Act. I think it's section 37. And it's for, you get a land tax exemption for someone who moves out of their property who's going to receive care, but you need to do that proper submission to the state taxes. And on top of that, you also need to set it, like everything in state taxes, you've got a laundry list of items you need to tick, and if you fall down on any single one of them, you don't get your exemption. So you need to step through all of that and make sure that you're entitled to the exemption. There is an exemption there. It's just a matter of applying the facts to it to make sure that you're entitled to it, and state taxes will accept it if you put an application in on that basis.
All right. Well, I think that's the end of the questions. There's been 3 very good questions from, there's been several good questions. We've had Bjorn, David, Scott, and hang on, we've got more over here, Dick. So who do we award the prize to, hey? So many people. Let me think. Bjorn's had a pretty good question. He gets a prize. Scott's had a pretty good one. He gets a prize. Oh, I'm going to offend someone else now. I think Scott and Bjorn are the leaders for the prize, and Dick, we'll talk with you offline, and hopefully we'll give you a prize of saving lots of land tax. But if anyone thinks it's unfair, bring it up with me, and we'll discuss further my discretionary prize giving. And look, we love talking shop on, all of these kind of, land tax issues and that kind of stuff. And, for accountants and financial planners, if you've got a scenario, Tom actually gets excited if he can find out some method where you might be able to structure better or do it better. So it might be that in, all of his wisdom, he's got some, great idea that can, save money or be a better structure. And look, there's been a lot of clients over time that have been very impressed with, some of the approaches to valuations and savings that he's been managing to get them in, these different kind of duties and land tax scenarios. So, it never hurts just to, have a quick call and say, hey, is there anything here? And see what's in it.
Yeah, definitely. Have a talk about shop.
And, we're pretty prolific on, the Facebook and the LinkedIn and the social media and that kind of stuff. Put things out on the YouTube and the LinkedIn and all of that. So please follow us. If you like us, find us on one of those channels and leave a recommendation. It means the world to us if, you can get the word out. We put these events on, to try to help you give the best service you can to your clients. And, it really helps us if you pay us back by, leaving us a good review or a good recommendation on one of those forums. We really appreciate it. So thank you very much for attending, and, hopefully we'll give you some kind of strategy so the whinging can be a little bit less in the future, or, at least you whinge a bit less if you know what's coming for you. You still don't like it, but at least you knew that you had some nasty surprises in store.
See you later.
Thanks, everybody. Thanks, Tom, for sharing your knowledge.
No worries.